Good afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to go ahead and cover the four major market ETFs like we do every Wednesday. We're going to look at the S&P 500. We're going to look at the Nasdaq Composite, the Dow Jones, and the Russell 2000, all through their stock ETFs: SPY, Qs, IWM, and DIA. If you like what you see here, you can always follow me on Twitter at StockDarts. You can find these videos at YouTube at StockDarts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, as well as expanding on some of the thoughts and ideas we come up with during these Wednesday webinars or Wednesday streams when we look at the overall market conditions. Let's go ahead and get started. First thing we're going to do is take a look at the ETF SPY, which is a proxy, of course, for the S&P 500. And as we can see, the market has steadily crept upwards. We are not finding any selling pressure whatsoever, which is... Hi, Celine. Nice to see you in here. Celine, Irene. Glad to have you in here. If you have any thoughts or comments, feel free to just type them in there. I'll be more than happy to go ahead and interact with you. If you have a chart that you want me to take a look at, feel free to type it in as well. Just type the ticker in, and we'll take a look at it when we cover the rest of the markets. So we're in an interesting place here with the S&P 500. The market, as I alluded to this a couple of weeks ago, that it looks like we're playing this elaborate shell game with the markets where we just kind of keep rotating back and forth, trying to get traders to chase the price action. But in reality, the market's not really going in much of anywhere. We're slowly making new highs. The S&P 500 finally made new all-time highs, and the Nasdaq is making new all-time highs again. Oh, Fat Boys, nice. I guess that's your wife or something. But anyway, even though we're seeing new highs on the S&P 500 and the Nasdaq, the Dow Jones and the Russell 2000 are stalling out. And you remember a week ago it was the opposite, where it was the Dow Jones and IWM that were kind of climbing upwards, and the S&P 500 and the Nasdaq were the ones that were kind of stalling out. So we're still getting a little bit of that rotation, where we're seeing different parts of the market go up and down, while in reality, in the broader sense, the market's not really going much of anywhere. You can see on the chart of the S&P 500 how this rising wedge has slowed down and flattened out, but we didn't actually get a break to the downside. We had that one red candle, and then we just kind of slowly have been drifting. So it shows that we're losing momentum, and the buyers are having a harder time pushing the market upwards as we come up into what is really big levels of supply. And we haven't really seen the distribution yet, though. So we haven't seen the selling come in and impact the market. So we're stuck in a spot here where, the bulls are trying their best, but there's not much left as far as their ability to push it upwards. But the sellers and the bears have not been able to impact it whatsoever. Now, probably what's going to happen is at some point, again, the S&P 500 and the Nasdaq are going to drop, and the weird thing will be, well, are we going to continue this shell game where we're just moving back and forth, and are the Dow Jones and the Russell 2000 going to be the ones that play catch up when we finally see a little bit of selling in the S&P 500 and the Nasdaq? And that's probably the more common or more likely scenario, but we'll go ahead and examine the different possibilities that could happen here. So first up is maybe we continue to climb upwards, right? And if we do, we're going to have an acceleration. But in order to trust this and expect a big move up, we're going to need to see a bigger green candle. We're going to have to see an actual breakout candle with volume, not these little candles that we keep seeing. Volatility cycles back and forth just like price does. And you can see this quite a bit on these charts where you'll have basically the candles get smaller and smaller and smaller, then eventually they get a little bit wider. We haven't seen any kind of wide volatility like what we had in June and July since then, right? And so we're likely going to have something like that coming soon. And usually when you have that kind of volatility, it's with a move to the downside, not necessarily to the upside, although there are occasions where you have these big breakouts to the upside and you have the volatility expand upwards. So there's a chance that we expand upwards. If we do, we're going to have to see volatility come in order to be able to trust the move and expect a big blast through all-time highs. But more likely than not, what we're going to end up seeing is volatility come to the downside, where we come and maybe test the 20 and break through it and come down and test the 50-pair moving average. Now, as far as the key levels that we can expect here, if we lose the 20, which is probably a decent scenario or a decent likelihood if we start to see volatility come in. I think the 50-period moving average and this level here right at 320, which is denoted by this red trend line, are actually pretty important and should act as good levels of support on the S&P 500, at least on the initial test of that area. And that would be a really good spot to look at buying the dip once we see buyers step up and confirm and support that area. Now, let's go ahead and kind of play out a couple of ideas here. So the first thing is maybe we get a shallow pullback, right? And so this is, let's go ahead and change this trend line. We're going to color it white just to give you a different look from the other trend lines, right? So if we get just a regular rotation that's been happening for the last couple of weeks, then we're likely to just come up and test the 20-period moving average, while the Dow and IWM maybe outperform. And you can see the IWM is starting to outperform a little bit today compared to the other three indices. And so what is likely to happen, and I think is probably the most likely scenario from here to next week, is that we get a shallow pullback on the S&P 500 and the NASDAQ, while the Dow Jones and IWM start to climb upwards. And if that's the case, we're likely to just get a move here to maybe the 20. Now, if we start to see volatility to the downside, and we see all four of the indices pull back together, then we're likely going to see a move through the 20 and towards the 50-period moving average on the S&P 500. And again, I would consider that to be a really strong level of support. I think the 20 would be a decent level of support as well, but I'd like to see a change. I'd like to see candles step up and show us that buyers are stepping in before I get too excited about buying this shallow pullback, because I don't know that this shallow of a pullback is enough to really change the market environment we're in enough to me to get excited about momentum coming back for the bulls. So, and what I mean by that is, as you can see, the momentum is starting to die down, right? So bulls are getting tired. The buyers are starting to really kind of check out. And I don't know that a move down to the 20 is enough to get new buyers with enough strength and emotion to be able to push the market through that level. So personally, if I see a move just to the 20, I'm probably going to continue to kind of keep it cautious and trade a little bit less than I've been doing recently, which already is a little bit less than maybe we've done over the last month or so. Now, if we get a move back to the 320 area, then I think at that point we have a decent buy the dip opportunity, because we will have had enough of a shakeout. We would have had enough selling come in to get new buyers that are willing to step up and support a value area. Now again, we need to see the buyers actually confirm support here, but at that point, I think that would be a good buy the dip area. And then of course, the last scenario is of course that we just break out. And if that's the case, I'm not that excited about buying a breakout at these levels, although this would actually be a very strong breakout on the S&P 500 and would be pretty bullish. And we've actually had pretty bullish signs over the last couple of weeks, so there is a decent chance that this sort of scenario occurs. And if that's the case, I think I'd be more willing to wait for the retest and then buy the retest of the all-time highs as they are confirmed as support as a better opportunity, rather than trying to chase the price action. Now that doesn't mean I won't trade to the long side if we break out. In all three of those scenarios, I'm basically only looking at long trades right now in the market. And that's because, again, there's just too much bullish action here, and there's not enough selling pressure for me to get behind shorting the market in any way. And that's despite the fact that I think the market is getting tired, and I think that we're due for a pullback. But we've said this over and over during these Wednesday streams. Just because the market's at highs, that doesn't mean you want to short it, because in reality, you're just kind of shorting in the face of strength. If you think that there's going to be a pullback when the market is this strong, you're better off just waiting for that pullback to occur and then using that as an opportunity to go ahead and buy the dip. I know a lot of traders get nervous, and the plan is, oh yeah, I'll buy a dip once the market drops. But then once the market drops, they freak out, and they think it's going to be indicative of a much bigger move to the downside, and they end up missing buying opportunities. And the last time that probably happened was here back in June and July, where we had a quick drop, but we came up and we found support, and it was established pretty quickly that was a strong level of support. And I think a lot of buyers kind of freaked out here and maybe didn't want to buy it when it initially broke out. And that's why we've had this kind of rising wedges, which is basically indicative of price. The price action is indicative of people chasing the price action, which happens because they didn't trust the initial bottom. And then as we start to climb upwards, they just keep kind of piling in because they're worried that they're going to miss out on this move, and that's why we get these patterns that are developing the way it is right now. And what ends up happening is eventually these people that are chasing the price action are going to get shaken out, and we're going to get a move back down to support. And yes, there's always the possibility that that move down is indicative of a market top, like what we saw maybe in March, right, where we have this big move to the downside, even though this was accompanied by a major news event and is, I think, more along the lines of a black swan event than anything else. But there are times when the market is going to top out and these buy the dip opportunities are not going to work. But when that occurs, you usually get enough signals to tell you that that's going to happen. And what you end up doing is you use proper risk reward management, and you end up, if you're going to try to buy a dip or catch a knife in these scenarios, you know exactly where your stops are. However, more likely than not, when you have a market that's trending like this, is when we get these pullbacks, they end up being good buying opportunities, and that's when you really want to go ahead and try to get more aggressive to the long side, rather than trying to chase the price action where it is right now. So, for the last few weeks, for those of you that are on my Patreon page, and you go ahead and go there for trade ideas and trade content, you'll know that we've been a little bit more cautious. We've been looking at a few isolated trades, but we've been focused on stocks that are at support and are coming out of tight consolidation ranges rather than trying to chase price action at highs. Because I don't think the momentum trade's really working that well right now. As you can see, as evidenced by the last week of price action on the S&P 500, momentum is dying. But what we're seeing is a lot of rotation. And if that's the case, then if you buy names that have already pulled back or are still in the process of starting to chase or starting to follow this movement upwards, then you can end up catching some moves that work in your favor while you wait for the market to give you a better opportunity. And so what I've been doing is just, I'll enter a trade, and then when I close that, then I'll look at a new trade. But I won't sit there and pile on trade after trade after trade and try to hold maybe 10, 15 trades at a time. I'm usually the kind of person that with my swing trading account, I try to hold 3, 4, 5 trades at a time. And what I've been doing now is if I have 3 trades, rather than try to push the envelope up to 5 or 10, you just wait till you close out a trade before you enter a new one. And you try not to get too involved because, again, the market is losing momentum here, and there's a decent chance that we will get a swift correction, even if it's not a big correction, but that we get a swift move back to shake some people out. And I think at that point, then it becomes a little bit more ideal to try to add more trades to your belt. So that's basically what we're looking at as far as the S&P 500 is concerned. Like I said, we've got a short-term support level at 331, intermediate-term support at 320. And I don't expect us to lose 320 from here to next week. Like I said last week, there aren't really any catalysts right now to push the market, right? We've got FOMC's out of the way. Earnings season, for the most part, is out of the way. I think at this point, the coronavirus is kind of a known quantity unless we get a big change in the news flow when school comes, when school starts, which we're starting to see school come back now. If we start to see an huge influx of new cases of people getting infected and they have to shut down schools, at least for those that are actually opening, then that might change. But for now, basically, coronavirus is a known quantity, and I think really up until the election, there's not a lot of catalysts that can really change this market. So we should just be going off of technicals. And that means that I don't expect to move down past 320 unless news really comes out of left field. So we should be trading off of these key supports at the 20 period and the 50 period. And then to the upside, I mean, obviously if we're at all-time highs, there's really no resistance overhead other than just theoretical. So we'll see what happens if we actually continue to climb upwards. But like I said, be leery of a move upwards if we don't start to see bigger green candles. Alright, so if we look at the NASDAQ, you'll see a little bit of a different picture. Obviously, the Qs are actually climbing upwards. We had a little bit of a move down. And again, this was something we discussed a couple of weeks ago. Right, this was when there was a little bit of rotation where the Qs were stalling out and the Dow Jones and IWM were actually catching up, right? And then what ended up happening was the NASDAQ finally recaptured some of its momentum, and it's broken out. And a lot of that has been off of the back of stuff like Amazon, which made a big move up. Tesla, of course, continues to climb upwards. based off of a lot of stuff, including their impending stock split. Apple, another stock that wants to split soon, has also been climbing straight up. So there's a lot of tech names that again have recaptured some of the momentum. And if you're looking at this and you're trying to figure out what's next, well, there are still a couple of the big FANG stocks that haven't really done quite the same. You can see Facebook starting to try to catch up again. Google has been lagging as far as the major FANG stocks are concerned, but you can see it's been climbing upwards. It's still kind of in a range, but I think overall, if you look, you can see all of them have been climbing upwards and kind of coming off of the lows and the support levels they're at. And again, so this goes to show you, this is exactly what we were talking about when traders say they want to buy a dip and then they get nervous as it starts to come to these levels. But it ends up that support typically holds, and you make your way back towards the top of the range, and that's what Google did, and that's what a few of these have done. So it's important that when we see these patterns, that we go ahead and we take advantage of them as best we can. Now, going back to the Qs, you can see again we've broken out. We're stair-stepping upwards. If we pull back, I expect the Qs to maintain some of their strength and likely just come back and test the 20. Maybe not necessarily come back and test the 50. Again, just like the S&P 500, those are the key levels we want to watch, right? And you can see this is actually kind of, we've already hit or established a new stair step, right? So here's what was the previous highs, and this was pretty interesting because again, we kind of went over this pattern last week, but we had a double top, and we actually broke down below it. But that ended up being a false breakdown, which was pretty quickly changed right after the next day, and that led to an explosive move to the upside. And again, at this point, what we're doing here is you can see it pretty clearly. We tested twice, failed, but then this was a false breakdown. We came up, we tested this level, and we actually confirmed it as support. Even if we had that one candle that broke down below it again, we came up and tested that as support. So as long as this pattern continues, you can see very strong trend on the Qs. Well, what we should do next is, again, come back and retest this new breakout and hold BAT as support as it comes back and tests the 20 and keep climbing upwards. And it's pretty clear now that the tech sector in particular is in a pretty nice uptrend and wants to continue this momentum. Until we see a change in this pattern, we should expect the other indices to slowly kind of continue to creep upwards and try to keep up with this. Now, if you're worried that the market is too high for you, or you think that the market is coming close to an impending top, or anything of that nature, well, you probably want to keep an eye on what the Nasdaq does. And I think the first real warning signal that the market is slowly losing its upward momentum and needs to come back and trade sideways or down will be when we see an erosion of this trend on the Qs, right? So like I said, if you think that we're going to have a bigger swing to the downside as we close out this year, then what you want to look for is, rather than just try to blatantly call a top here and try to short a market that's at highs with strength underneath the surface, what you want to do is you want to keep an eye for eroding price action. The first thing you want to see is the price start to get back below the 20 and testing the 50. But more importantly, you want to see this trend shift. So you can see we're very clearly in an uptrend. And I guess let's just draw a new trend here. Right? We can color that green. We're not going to keep that trend line, but so the first thing you want to see is you want to see this trend break, right? And even if this trend breaks, that's not indicative of market top. That just means that we finally lost momentum on this rally and needed to come back and take a bigger breather, right? And if that's the case, we're going to come back and we're going to test, well, to break that trend, we're going to lose 270, but we're probably going to come back and test this 255 area. Now, if we lose 255, I think that's your first real warning signal that the market is losing a lot of momentum and is likely going to need to head further south, right? Obviously. The next key level is 237. And I think as long as we're above 237, the market is still in good shape. Because again, those are the previous highs from earlier this year. Notice how far the Nasdaq has left that behind in the rearview mirror, right? This is what happened. This is where we were before the coronavirus. And look at where we are now compared to that, right? So the tech sector in particular has done extremely well this year. And for a good majority of it now has just been carrying the rest of the markets. Um, and so if you're worried about the overall markets, the first thing you want to see is you want to see erosion in the price action of the Nasdaq. And like I said, I don't know that we're going to come back and test and lose this 237 level. We're going to have to see a lot more news flow in order to do that. And the thing is, even if it's due to coronavirus, because so many of these tech names are insulated from the parameters that we've put in place to kind of combat it, the self-isolation, staying at home, working from home, a lot of these tech names are benefiting from that. So if that's the case, and that's what is going to cause pressure in the markets, that might not really affect the Nasdaq as much as the others. So keep that in mind as well. But I think overall, again, this is the strongest index. This is the strongest area of the market. And until we see a change in character here, we should probably expect the other indices to kind of play along and try to catch up, even though they don't have the strength to kind of to really do that. And I think, again, the biggest thing to take away from this is a relationship that we noticed back in March, right? And this is something that has been in play all year, and that is that this market is basically divided into two sectors, or two areas, right? You've got the names that are insulated from our economy's slowdown and shutdown, and names that are not, right? And a lot of these tech names are. So for the most part, it's the same story that I've been harping on since March, which is go long tech names and stay away from some of the smaller caps or some of the industrial names that have been hit a lot harder by this coronavirus. And that's really the same scenario that's in play even now. So keep that in mind as you continue to particularly with your longer term holdings. You should be very comfortable holding tech names, and you should be a little bit more leery of holding these industrial names or retail names that have been struggling and are likely going to continue to struggle as we continue to get these resurgences and infections across the country. All right, so those are the key levels to watch. Let's take a look at the Dow Jones, and here's where we first start to see a little bit of a discrepancy in chart patterns. You'll notice with the S&P 500 and the Qs, we're just kind of drifting upwards into resistance. That's not really at all what we're seeing in the Dow Jones. We're actually flagging. This is actually a healthy consolidation pattern. We're not actually, chasing the price action upwards. We're actually kind of just biding our time, consolidating, waiting for the next move up, right? And in a lot of senses, this is actually a little bit more of a bullish pattern waiting to develop, as opposed to the others that are just drifting upwards. This is actually the type of pattern you want to see when you're trying to go ahead and play momentum to the upside. And so this leads me to believe that the most likely scenario is one where we just see money rotate out of the S&P 500 and the Nasdaq as they settle down, and we see it come into the Dow and into IWM as these try to play catch up again. Now, you'll notice again, these aren't anywhere near all-time highs. The all-time highs on the Dow Jones are up here around 295 or so. And you'll see we're only at 278, right? So plenty of room to go up in order to catch up to that. But we're likely going to face some pretty critical resistance here, just like 5 points away, around 283, 284, and then the gap fill around 288 if we can break through that. So here's the thing with the Dow Jones. I think that it looks like it wants to kind of have money rotate back in and try to play catch up, but we have such strong overhead resistance that there's a decent chance that once we get a green candle or two, we're going to stall out and come back and maybe follow the S&P 500 and the Nasdaq as they pull back. So makes it a little bit more difficult to go ahead and really want to get too excited about playing to the long side once we see a green candle or two. But for now, that's what we're looking for, is a move up into this level of resistance, and then from there we'll see how it handles that and how we go ahead and move forward from that. Now, as far as the key levels to really watch, to the upside, we already have them, right, which is 283, which was, as you can see here, if we go back to the earlier part of the year, right, before we had the whole COVID-19 shutdown. So this was a pretty important area, this 284, right? That was what was previously the highs. We were able to break out above it, and we used that as a launching point to keep trying to rally throughout the beginning of the year, right? You can see we closed out last year, then we came up and we tested around the 290s, came back and fell, found buyers and came up and did it again. before we really started to see the ramifications of the coronavirus in the country, right? And that's when we broke right through that level and just came, didn't even look back, just came all the way back down to the 230s. Now, we've finally coming up close to that level, right? And that's an important level. Now, the NASDAQ and the S&P 500 were able to break through that, so it makes sense that eventually the Dow Jones will break through it as well. And so when we come up to that level, the question is going to be, are we going to stall out before we break through it, or are we just kind of just blast right through it and come up and try to fill that gap that was created in late February, and see where we go from there. So that's the next step up as far as the Dow Jones is concerned. If it wants to continue to maybe chase the S&P 500 and the Qs and try to keep up with them. Now, if it comes down, what levels are we looking at? Well, the 20-period moving average is the first level. I think with the Dow Jones, more than anything, it's a little bit below the 20-period, around the 270 level. And then below that, we've got this nice movement of moving averages. We've got the 50 and the 200 right around the 260s. Those should hold as pretty good support in the short to intermediate term. So again, I'm not expecting a lot of movement to the downside, even on the weaker indices like the Dow and IWM, because we have so much emerging support just beneath it, right? You can see the moving averages. We discussed this a couple of weeks ago. They're indicative of what is now becoming a nice trend to the upside. And even though for the most part the Dow has been climbing, it was actually range bound for a good portion of the last 2 months, right? You can see from the end of May to August, we basically have been trading a range between about 250 and about 270. And we're finally breaking out and through that range. And so the question now is, are we going to leave that range behind? If that's the case, then we shouldn't really move back below, say, maybe the 20-period moving average as we come up and retest that breakout and then eventually move past it. But if we do kind of falter and head back into that range, well, we've got all these moving averages now to support price. And then if worst case scenario, if we fall below all that, we've got a major level of support here that we established in June and July, which should act as a really strong barrier for the price action to really fall any farther below that. So I think at this point, like I said, even though I'm expecting some short-term correction, I think intermediate to long-term, there's a lot of levels of support here that should stop us from thinking about a market going back down too swiftly. I think more than anything, whenever we do end up losing this bull rally that we're seeing, it's probably more likely that we trade sideways rather than make our way back down to some of these lower levels. But we'll get to that. Whenever that happens, that's why we meet every Wednesday, so we could adjust our thoughts and our attitudes on the market on the fly, right? So I think from here to next Wednesday, we shouldn't expect to move below more than the 20, possibly the 50, but I doubt we get to that. And there's a decent chance that what ends up happening is instead the Dow Jones and IWM make a run for these levels of overhead resistance that are just above them, which we'll see in a second now with IWM. So here's IWM, and as you can see, the Russell 2000, again, slightly outperforming the other indices today. They're all up about 0.1 to 0.2%, and IWM is almost up, is 0.7, so they were a little bit higher than that earlier today. Same thing, we got a bull flag. We've got a breakout from our previous range, which I'll highlight just to give you an idea of what's going on here. So this gives you a good idea sometimes, by the way, when you're analyzing the market, understanding your time frame and understanding what a market is doing across different time frames, right? So in the longer term time frame, we're still in a nice uptrend, right? But in the intermediate term, we're just breaking out of a nice range of consolidation. So unlike the S&P 500 and unlike the Qs, they're maybe a little bit more tired because they've been kind of just ramping up for a while. IWM and the Dow Jones, they've actually had a nice bout of consolidation to kind of have new buyers step in and support the price action as it moves upward. And what we're seeing now is we're seeing a breakout and we're seeing a retest of that breakout. And right now it shows that the buyers are pretty safe in that they're not even letting it come back down to test the 153 level that was the breakout from the previous highs, or to come back down and test this 149, 150 area, which was from the previous level of tight consolidation, right? So overall, again, this is bullish. The problem, of course, is that we're right at overhead resistance. IWM has made its way back to that red line, which again indicates the support level from earlier in the year that I put basically on all four of the indices. If we can push through this, I think IWM makes a good run for this gap here, around 162. And at that point, it's getting pretty close to recent highs. And so that again is pretty bullish, and it shows that the Nasdaq is leading the market upwards, but the other the other three indices, they're following suit. They're playing ball. They're trying to keep up. IWM isn't coming back down and breaking to new lows while the other three are going up, which has been the case through a good portion of the last couple of years. So overall, this is showing that there's actually nice bullishness across the board when we look at all four of the market ETFs, right? So overall, things are actually more positive than you might feel they are, just because the market is kind of slowing down at its highs. All right, so to the downside, like I said, the key levels are going to be those ranges we just talked about. So we're looking at 153 as a potential pullback area if we see selling on all four of the indices, and possibly down below that. But again, just like the Dow Jones, we've got the 50 and the 200 bunched up together right around what was a previous level of price action, and that should act as pretty strong support if we do have a quicker move down in the markets over the next couple of weeks. And I expect that to be a good buy the dip opportunity if we come back to that level. Now, below that, the major level of support here is down around 137. I would not really want to see the price action on IWM come back to that level, because that would be indicative of a pretty big move to the downside in the markets. So if we get to that level, I still think that's a good strong level of support, but we'd have to be a little bit more cautious and actually see the buyers step in and support price action. But more likely than not, from here to next week, we probably don't lose the 20. If we do, we most likely don't lose the 50 and the 200. And there's also, like I said, a good possibility that we actually just break out and try to come up and test up to this level. So that's the four major markets. I know that I basically pointed a scenario where we go up or down. So the prediction, it's not really that fantastic as far as someone looking to try to figure out what they want to do next week. But the truth is that a lot of times with the market, there's potential for moves in both directions. And, we're not really supposed to guess where the market's going. We're supposed to outline potential scenarios and then react as they occur, right? And so the good thing with the way the market is right now is that it's pretty easy to react to what it's going to do, because it's trading in a pretty tight range, right? So even if we just look at IWM here, right, you can see it's trading in a nice tight bull flag. So it's easy for us to react to the market. If it wants to break out, well, it's going to break out of this bull flag, and we'll be able to see it as it starts to do so. Once it starts to climb above 158, we already know that it's starting to break out. We don't have to wait for a move all the way to 160. We can start as soon as it starts moving above those levels. Now, same thing. If the market's going to pull back, well, we'll know because it's going to lose this short-term support around 156, and it'll start to come back down. And so we have we understand what the market is doing, and then we just play it along the lines of the levels of support that we just identified as to where we want to go ahead and start looking for signs of reversal. And same thing for the upside. We know where we want to look for levels to take profit if it starts to break out through those levels. And that's how you want to go ahead and approach trading. You don't want to just take this bold stance and say the market's going up, right? So, maybe if I just went out there on Twitter and said, "Oh, market's going up, quote me," people might appreciate that boldness, but the truth is that's not really good trading sense. The way you want to go ahead and trade is you want to identify the two types of scenarios that can occur, maybe assign probabilities to them, but really you don't want to try to trade them until you see those scenarios start to play out. And at that point, that's when you go ahead and take your chances. That's really how you go ahead and get higher probability setups, and how you avoid getting into trades too early or guessing which direction a market's going to go, is you want to identify what a market can do, and then when it starts to show you that it's going to do that, that's when you go ahead and get long. That way you're not holding a trade for a month while it does nothing, right? You wait till it starts to make its move, and then from there you can go ahead and get a little bit more excited about trying to get involved in that trade. And so that's how we try to approach it here. Okay, so that's the major market. I think the most likely scenario is that we continue to rotate, which means IWM and Dow Jones probably go up while the other two stall out. Uh, and if that doesn't occur, then probably all four will pull back together. All right, so let's take a look at the U.S. dollar. Then we'll move on to oil, gold, silver. Again, if you have a chart request, feel free to type it in. I'd love to see what you guys are looking at, and if I can help you out with your read on the chart. So the U.S. dollar struggled again this week. We were finally getting a little bit of a bounce today, but overall we're lower this week than we were last week, which again is lower than the week before, lower than the week before. So the U.S. dollar is really struggling. You can see it here in the UUP index. Now if we go to the weekly to get a bigger picture of what's going on here, you can see that the U.S. dollar, we had that massive volatility, of course, when the economy was really starting to get hit with, and basically the world was starting to come to grips with what was happening with the coronavirus. And since then, as we've reacted and really put a lot of stimulus into the stock market, you can see that we've devalued the U.S. dollar quite a bit, and the U.S. dollar has really struggled as it's lost value and come all the way back down to this 25 level. Now, in the longer term, we are approaching levels of support that maybe are going to eventually stabilize here, stabilize the price, right? So you can see we've got this nice area here, which was from way back in 2018 and 2019, around 24, which lines up kind of where we bottomed out in March. And we're getting close to that level. Now, this, of course, is just the index, but as we go into some individual currency crosses, you'll see the same sort of scenario play out, right? Where the U.S. dollar is maybe finally getting close to an end as far as this is concerned. So here's the U.S. dollar versus the euro. Now, in this particular case, up is good for the euro and down is good for the U.S. dollar. So this entire move here shows, again, an erosion in value for the U.S. dollar. And that's one of the bigger stories of this year, at least the second half of the year, is the U.S. dollar losing a lot of value, right? And again, if we go to a weekly chart and we see where we stand right now, if we go back longer term, you can see where we are versus what the euro has done, and you can see there was a decent area here where we had a shift in character. Now the major level, as you can see, there's a lot of room here for the U.S. dollar to continue to lose value. The euro has traded in the 120s versus the U.S. dollar quite a bit, especially if we go back and we take a look at a monthly. You see exactly where it was before. You can see that this is, there's some pretty key areas here, and the euro has had strong value versus the U.S. dollar before. However, there are a couple of key areas here in the 120s, from 125 to about 123, maybe 122, where we could see the U.S. dollar finally kind of stabilize. Now, why are we looking at this? Well, because this is going to have ramifications across the board. Fat Boys, you're asking about Bitcoin. This is one of the issues here that Bitcoin has started to really take off. Part of it is because of the erosion in the U.S. dollar. And we'll actually take a look at Bitcoin. There's been a lot of movement and a lot of momentum coming into not just Bitcoin, but a lot of alternate coins too. And cryptocurrencies are really starting to gain momentum again. And part of that, again, is because of this weakness in the U.S. dollar. So I know a lot of people that maybe come to these Wednesday streams aren't really Forex traders. So this almost feels like wasted time when I look at the U.S. dollar. But a lot of times you have to understand that, the world is basically priced in U.S. dollars. And so the behavior that we see on it is going to have ramifications across the board in the stock market, in commodities like gold and silver, and even stuff like Bitcoin, real estate, everything. So it's important that we understand what the U.S. dollar is doing. And so at the moment, we had the euro tried to break out and failed. So it looks like the U.S. dollar is still trying to bottom out. If we look at the U.S. versus the Canadian, again, really struggling. Just keeps kind of dropping, and it's at this point I wouldn't even say this is a bottom or a potential bottom. It's just slowly dripping down the bottom of that channel. So struggling versus the Canadian as well, and then finally, if we look at it versus the Japanese yen, we'll see the same thing. It's struggling. It came up we pointed this out last week, right? It was going to come up and test this 106 level. It failed, and had 3 strong days just dropping right away. And is now, again, trying to stabilize. Now, the one thing is, on this particular case, the U.S. dollar has been stronger versus the yen, versus the other two currencies. And you can see it again playing out where it actually isn't making new lows yet. It's trying to hold up at a decent level, right? So in that respect, it's a little bit better here than it is on some of the other currency crosses. And so if we're looking for a shift in strength in the US dollar, the first place we're likely going to see it is versus the yen, because the yen has also been weak versus the dollar. All right, so what kind of pattern can we see? Now, the interesting thing is gold and silver actually have still kind of, in the very short term, struggled a bit. Now, you can see the US dollar had a little bit of bounce, and gold actually took a pretty big drop. Now, it did start to climb upwards, but with today's move, it is starting to stall out again. Now, I pointed this out last week. This big move is indicative of a pretty big shift in character for gold and silver. Now, I don't want, they're not topping, but I think that this explosive up move is done for now, and that they're going to range sideways. And gold and silver does this quite often, where they have these explosive moves, and then they kind of consolidate in these really broad ranges, right? Let's go back to a weekly chart and take a look at it, and you can see that it often moves up, and then it has these broad moves, these broad ranges of consolidation, as it slowly makes its way up. And I think we are in the process now of another one of these broad ranges of consolidation. So I expect this level around 180 to be a good floor as it comes back and forth through that level, and so that's a good area to buy. And the ceiling, I think, is still under development, but I think we're starting to see what could possibly be a triangle developing rather than a rectangle. If that's the case, then it might kind of contain itself along these lines. So we'll see how that plays out from here next week. And so here's SLV. And with SLV, again, you can see the same broad kind of consolidation as it just chops back and forth between about 23 and about 26. And so I think in this case with these two, with gold and silver, we want to look at them as range bound for the moment, not necessarily trying to break out and continue this uptrend. I think at this point it's pretty clear that they've kind of used up their upwards momentum and are now going to just consolidate as they try to reach a stable price. Now, the last commodity we want to look at is oil, and oil is actually still pretty bullish in what it's been doing, even though it's doing it in, it's a very slow motion move here. And I think even in the daily chart right now, it's kind of hard to see because we have to get rid of that negative price tick that we had from earlier in the year. But if we do like a 4-hour chart, so we can get a better picture of the price action, we zoom out a bit so we can see what's been happening, and you can see that it's slowly just building momentum. Right, it was struggling with 41. We pointed this out last week. It was just kind of going back and forth. It tried to break out and failed. Then it had a false breakdown and it came up. And at this point, it clearly established that 41 is a new level of support, right? And then we pointed this out last week, this range of consolidation. And you can see this week it's breaking back above it. Now, it's really still struggling to break out through highs, but it's just slowly making its way upwards. Now, if it can't break through 43, 44, we're going to see a change in character, and at that point it's going to make its way back down to 41. So if you're looking at oil, watch to see if it could break 43.50 or so. If it can't, then it's going to come back down and test 41, and at that point then we have a better picture. But it's basically range bound, a lot like the U.S. market right now, the stock market. It is pushing upwards, but it doesn't have the momentum to really make its way upwards in a strong manner. So, it's just kind of doing the same thing where it's just kind of slowly climbing upwards, but can't really get past the level of resistance it's at. But at the same point, the sellers haven't been able to impact it. So let's take a look at Bitcoin. It's a good chart request to take right now because its behavior is very similar to what we're seeing with gold and silver. Now, so your question is, will it come back to 10,000? Possibly, that is a breakout level it needs to test, but the momentum I'm seeing on it right now, I don't expect it to come all the way back down to 10. Um, if we look at a weekly chart of Bitcoin, and we see what it's doing here, right? Let's make a trend line at the 10K just to get an idea. Alright, so that's 10. Alright, that's basically 10K, right? You can see that's kind of an important price level. Uh, we were able to break above it, failed, came back, tested, failed, and then finally broke through it, right? So um, I think if you're looking at this as a long-term trade, if you know the intermediate to long-term, I think you could be patient and wait for 10K. There's a decent chance we're going to come back and test it. However, it might be a few weeks, even months, before we come back and test that. Because at the moment, we're dealing with all this overhead resistance, and we're trying to push through it, right? And I think that it has the momentum to try again, to try to get to maybe 13 or 14. But if it fails, then we'll come back and test 10. And again, you can see it's a pretty important area, right? We even with this breakout, a lot of times with these breakouts through these trends, you come back and retest them. So let's go back to the daily chart now that we have our longer term picture in place. And so this is what's happening right now with Bitcoin, is that it's struggling. It's struggling to get above about 12. You can see a failure today. And I think even in the so this is what it's doing. I guess we should change that as well. Alright, so this is what Bitcoin's doing in the short term or intermediate term, right? And you can see it found sellers here and has come back down, and it's likely going to break this downtrend or this uptrend. But when that happens, I expect it to come back and trade in this range. Not necessarily come all the way back down to 10, right? So if you're looking for a short-term entry, then I think probably 11 is a better bet than 10. But I think if you're looking in the long term, there's a pretty decent chance it's going to come back and test 10 again. I don't know that it's had enough of an explosion, but you can see volume has come in, and it's picked up a lot of momentum. And it's not just Bitcoin. There are a lot of cryptocurrencies that are picking up big moves. And even a lot of the more obscure ones are picking up momentum as well. Usually when that happens, they pick up a lot of momentum and they move together pretty well. So there's a decent chance that Bitcoin goes up more before it comes back and tests 10. But I think if you're looking at a bigger picture scenario where you have plenty of time to wait, then you could wait for 10,000 if you really felt like it. But I think with the momentum that it's seeing right now, it probably is going to find support at 11 rather than 10. And it'll be a while before it comes back to test 10. It could happen, but I think more likely than not it tests 11 and tests higher before it comes back to 10. So hope that helps answer your question. I'm not sure. Are you looking to get into Bitcoin, or do you already have some? For what it's worth, I already own quite a bit of it. All right, so let's look at SFIX. I know you're long that from my tweet from last week. We'll get an idea of what it's doing. Today's not a bad day to take some profits. Maybe not close out the trade, but at least take partial profits. I don't know how you're managing this trade, but this is a good example. By the way, for the other viewers that are in here, This is a good example of what I was discussing earlier about how I like to manage trades by looking for plays that support rather than chasing the price action at highs. Looking for support plays as they break out of consolidation ranges. So Stitch Fix was interesting because this was a little like the NASDAQ where we had a false breakdown, right? We had this pattern. It was trading in a range, and 23 or so was good support. And then we had a breakdown, but you can see it held support just beneath that level at the 20 or the 200 pair moving average, and then it started to break back through that. And as soon as it broke above 2280, it made for a good entry signal and a possible move. And that eventually played out, and it's made its way all the way up to about 2550 today. You sold half, which is good. I would have done basically doing the same thing. So what you're looking at here is, I don't like this area here. So that was target one. Now target number two is going to be up here around 28 or so, right? There's rather than trying to stop out at 27.45, I'm going to look for 28 to 28.50 as the next key area. And if it comes back down, then you just stop out, right? Rather than let it turn into a loss. But yeah, this was a key area. You can see a lot of distribution here, a lot of selling pressure from the last time it hit this level. So this is a good spot to take some off, right? Which you did, which hopefully you did today. And that's a really good spot. But we'll see. It has shown momentum. So if it can break through that, then I think it can make its way back up into the 27, 28 range. And that'll be the next target, and probably the last target on this trade. So the other trade I was pointing out to you yesterday, I stopped out of this one, which is OLLI. And again, it was the same thing. Even though this one actually is a stock that's near highs, if we zoom in, it was doing the same thing, right? We have this support level, and it was trading down at that support, and we had a really nice move on Friday, right? No, on Monday. And it reached the point where I was able to scale out of half of my trade as it came up and tested previous highs, which is how we always take this. But then yesterday, it just came all the way back down. And, at that point, I just kind of stopped out because it basically broke. It broke the uptrend that was in place. And again, I don't want it to come all the way back down and turn a winning trade into a flat trade or a losing trade. So, this is one of these things. A lot of times I'll discuss the types of trades that we take, but maybe not go through all the management techniques. And so this is a trade that, in the end, could still probably make its way higher. But because of the reversal we had yesterday, this was a spot where I basically just said I already booked half profits, but I just closed out the rest because I didn't like the momentum shift in it. And even though in the end it might end up going back towards its highs, at this point it basically lost my faith in it. And it's not a market where I want to stay involved too long in stocks. So rather than kind of hold this and hope for it to continue to behave well, I'll just make a move for a different name, right? So that's how that one is managed, and how Stitch Fix is being managed at the moment. Okay. All right. So I guess that covers it for today. If anyone that is watching this as a recording, or the other viewer that's in here now, if you have a chart request that you don't want to really ask in public, you can always message me on Twitter, and I can just send you the chart that way. You can email me, stockdarts@gmail.com, if you want that way. I'd be more than happy to give you my take on any chart. If you like what you see here, like I said, you should go ahead and visit patreon.com/stockdarts, where I post weekly blog content, and a lot of times it's trade ideas like these. We've been on a pretty good run. Fat Boys, I think since you've been following me, I think pretty much every week, I'd say a good 75% of our trades have been winning trades, at least the ones that trigger. So hopefully that has helped you as far as your trading account is concerned, because we've been on a very nice run, and every week most of the trades do work in our favor, and it just becomes a matter of managing them rather than finding a stock that's going to go up for us. So for those that are interested, feel free to visit that page. Some of the content is under subscription, but a lot of it is more early access rather than completely being hidden behind a paywall. And it's $8 a month, which I think is a pretty cheap when you consider the prices of newsletters and subscription services nowadays. And it's really just more a matter of making sure I get serious people to follow. So if you have any interest in that, make sure you check that out, because we've had a lot of good trades, and Fat Boy's glad to see that it's working for you and helping you. And I think the biggest thing is you get into these habits of understanding what stocks give you good setups and good high probability trades, rather than trying to chase momentum. And there are times when chasing momentum works, but I think it's more important to make sure that we manage our risk and understand what a good trading opportunity is, rather than chasing stocks that have already moved without us. Good. I'm glad that you're getting your money's worth for it. So good to see that you're happy. All right. So again, that covers it for today. Um, we will meet again next Wednesday. Have a good rest of the day. Okay.